Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
There's $500 billion in dry powder looking for yield. And right now, it's staring at the mobile home park space. So, does that make this the golden age of mobile home park investing? Or are you about to get priced out and miss the opportunity of a lifetime? That's the question that we're going to discuss here today on the MHP Exchange podcast. I'm your host, Frank Rizzo. And is this the golden age of mobile home park investing? I've operated in this space for over a decade. Bought my first park in 2013, and it is tremendously different how this space looks today as it did over a decade ago. When I first got involved, one of the things that drew me to this space was the fact that it was 80% dominated by mom and pop operators across the country. And right now, those numbers have changed, and they've changed pretty drastically, especially post-COVID. What's happening on the ground today? And I think we've seen it. For those of you who have been in the space, who have been looking to buy parks, especially in these larger secondary, even tertiary markets, it's being gobbled up by private equity companies like Blackstone, like Carlyle Group, REITs that are sitting there and looking this as almost like a land play or land bank, and they're compressing cap rates. The first deal that we bought, and when we were looking at that time, it was not uncommon to find parks trading at a 10 to 12 cap right off the bat. I mean, you're talking about significant yield and consistent cash flow. Today, those same parks that we were looking at 7, 8, 9 years ago at entry 10 caps are probably trading at a 6. And we've seen portfolios in this market, in this environment, trade at a 5 cap or below with the understanding that you're going to eat the first year before you could create that value and move rents up or create value in the park where the deal starts to make sense. And why is this happening? Because institutions know that there is a very sticky resident base. There's low churn. There's sticky residents. And you have the ability to operate these communities at some of the best margins in the real estate investment industries. I mean, any asset class inside of real estate, the same store growth here over the past decade, mobile home parks have far exceeded pretty much any other subsector in the market. So with Wall Street here or getting involved, is that a benefit? Is that not? You know, there's pros and cons to every situation, and you've got to look at, you know, some of the negatives and some of the opportunities that are there. I mean, here's the benefit. I mean, this is leading to higher valuations for these parks. And those higher valuations means for people who own communities, there is access to bigger exits. So you can execute on your business plan with a larger runway for growth and opportunity. And quite frankly, there wasn't the liquidity in the space that we see today 10 years ago. So that's a plus. But what you're also seeing is a trend to having better, more professionally run communities. Because at the end of the day, you know, this is a very people-based business. It's a community-based business, and has had the impact of making people look to raise the standards and raise the bar of the type of communities that they're looking to run and operate. Now, what are some of the cons of having this capital, having these entities start to now enter this space? Obviously, for the solo operator out there, you're losing pricing power. You're losing some of your negotiating power, especially when you know when an opportunity comes around, you might have some very deep pocketed competitors looking at that same, opportunity. Residents are feeling this, can be feeling the squeeze. Quite frankly, what's drawn Wall Street into this is the fact that from a spreadsheet, this looks like a very compelling economic thesis that why they want to be in this space, and losing that touch and only operating from the vantage point of a spreadsheet and looking where we could push rents without necessarily adding services or cutting services in a lot of cases, and not really adding value. Well, that's squeezing a lot of the residents that are in these affordable housing communities. And it's also leading to increased local resistance and possibly future regulation risk across the board. And we're already seeing that in some states, and it's starting to spread out, across the country, that you're hearing of these tenant advocacy groups or these rent control initiatives. And when they start, they don't necessarily stop. So you have to keep that on your radar. And at the end of the day, who works best in those highly regulated environments? Well, the Wall Street firms like that, because it does push out, that regulation comes with a cost. And when you're, a solo operator, maybe on one or two parks, it's tough to mitigate that cost out. So what Wall Street's betting on isn't the cash flow alone. They're not just looking at the fact of the sticky resident base and the cash flow that creates, but they're also banking on the fact that, quite frankly, America has a housing shortage. And this is something that's been brewing for 15, 16 years now. I've had the opportunity to be in the real estate space for over 25 years at this point. Not to date myself, but over 25 years. And there's always been a baseline new housing starts that this country would have. And once the Great Recession hit in 2007, 2008, housing starts dropped. And for a number of years, we were consistently producing under the median average of 1.1 million housing starts a year that we needed to keep up with the pace of population growth. So what's happened is that we're somewhere between, and economists will say this, somewhere between 4.5 to 6 million homes short of what we need to adequately supply the nation's population. And that political inaction on affordable housing, because it is a complex issue, right? That political inaction, right, has now created the recipe for more people to get into the affordable housing space. So when it comes to, mobile home parks, it's not just, they're not just buying the park. They're looking at this as a yield curve. It's not about the rent. It's about securitizing income streams. It's about mezzanine leverage. It's about refinancing plays. It's about the opportunity that they have to create this financial maneuvering, which creates these outsized returns for them. So they're looking at this slightly different than the operators in the space might be looking at this. So you're looking at this as an investor in the space. So what are some of the tactics or the strategies that you can apply right now so you could still succeed in this MHP space, right? Like, you're here, you're listening, you realize that this is an opportunity that you want to be part of. So where do we go from here? How do we profit in this, or how do we benefit from knowing this? I'm going to give you 3 strategies that you could look at today and that can help you succeed, even though your competitor that you might be that might be going for the same park might have deeper pockets than you. Number one, you can't fight the institutions coming here. There's no way that you can block this. This is a trend that's happening. It started. The momentum is there. So don't fight it. But what you can do is position yourself to feed them. How do you do that? You got to look to partner up, whether that's through syndication deals, whether that's working with other operators in space. You can do that to help build your portfolio up, right? You can create future liquidity by watching and seeing exactly what these larger institutions are looking for in the communities, how they're looking for those communities to be stabilized, and aligning your operations with the institutional KPIs, right? To make sure that your community is going to be something that's going to be on their radar screen 3 to 5 years down the road, 7 years down the road, wherever your business plan takes you. Number two is that you have to focus on building operational efficiencies. Now, what do I mean by that? It's not just in cutting services, right? That's not the way that you want to create the efficiencies. The way you want to create efficiencies is by using technological advancements to make sure your operations are on point, that you could run your community well while also adding services, adding amenities, and keeping that community feel that residents first bought into in moving into that park. You used to wonder why residents would stay in a park that was substandard by our look and feel of it. Why would you stay in a park where the roads have maybe been, have fallen apart, or the infrastructure was falling apart, or the roads were, rocky with big potholes, or maybe there were some hazardous trees? And why would these residents stay? And the idea behind it was always, well, it's very expensive for a resident to move a home. It's $10,000 to move a home. And in many cases, these residents don't have the capital to do that. But I'm going to tell you from my experience, it's not just that, because we've seen operators who've come into the space with a lot of capital. And there was one group who, had $150 million to deploy. They deployed that capital, and they raised rents. They thought that residents would stay, and they saw residents leave. And why would residents leave when the thesis is they didn't have the capital to do that, or the money to do that? The reason is they no longer felt a sense of community in the park they were living in. So in building those operational efficiencies, look at ways where you can build community efficiencies, where you can get people more engaged, and you can beat the institutions at that game, because you can have your ear to the ground a little bit closer. You can understand what's happening there. So that's a key point. And then the last thing that you can do, the last thing that you could do to beat the institutions, you could beat Wall Street at the game of mobile home park investing, is that you could look for deeper value. Right? You could roll up your sleeves and do the work that they're not really willing or able to do. Right? Everybody wants that light value add. The park that's 80% physically occupied, maybe do a little bit of infill, rents are slightly below market. They can do some beautification, maybe put in a playground, raise the lot rents, and call it a deal. You might have to look a little deeper, right? Pull back the veil a little bit more and be willing to do some of the work that they are not willing to do. And that's where you can find value. Like, we recently picked up a 47 lot community in one of the fastest growing counties in North Carolina. And we were able to acquire this community at a tremendous basis. I mean, we were paying roughly about $12,000 a pad in a market where they're trading at $70,000 to $80,000 a pad now. Why were we able to do that? Well, we knew going in that we were facing 19 evictions. We were facing drug dealers that have taken a home base on that community, and a couple of squatters that were in some of those homes. Now, that's a community that is not going to be on their radar. But we can go in there, and we're willing to do that work, to do that cleanup work, because we have the team and we have the processes in place to be able to handle that situation. So we can play where they're not looking, and get that community to where it needs to be, where 3 to 5 years down the road, the institutions this is something that they'll want to be in, a market that they're going to want to be in. So look at rezoning plays. Look at expansion plays, infill upsides, operational cleanups and really those neglected communities that have been an eyesore, which become a big value add opportunity for you. So their value add, don't forget this, their value add is the capital structure they have, is the access to capital that's not going to be available to the average investor. And that financial maneuvering is how they create, greater returns for them. We might have to roll up the sleeves and do the work, but in doing so, we could create the communities that we envision, create the opportunities we want, create a better resident experience on the ground for our residents, and create that value for us with the consistent cash flow. So there's still an opportunity to do that. And if you want our playbook, send us a line, drop us a line on the link below, and we'll give you our playbook of how we succeed when Wall Street is coming for your trailer park. This has been another episode of the MHP Exchange podcast. Thank you for listening. If you found value in this podcast, give us a rating on where you're listening, whether it's iTunes or Spotify or whatever system you are. Drop us a rating, drop us a line. Until next time, everyone, happy investing.